Imagine you own your home outright and rely on your monthly pension to get by. After decades of working, everything finally feels stable. Then a letter arrives from Service Canada. Your benefits are reduced or completely canceled, and suddenly you owe thousands back. Not because you did anything wrong, but because of a decision involving your home that quietly triggered rules most Canadians do not even understand. And by the time you find out, the money is already gone. Imagine you are a Canadian homeowner in your late 60s. You worked for 35 years. You paid into the Canada Pension Plan every single paycheck. You filed your taxes on time every year without fail. You saved what you could, and you made the one financial decision that every advisor, every government pamphlet, and every well-meaning relative told you was the smartest thing a Canadian could do. You bought a home. You paid it off slowly, painfully, over 25 years. And now it sits on a quiet street in Sudbury or Red Deer or Moncton, fully owned, mortgage-free, representing the single largest asset you have ever accumulated. Retirement arrives. Your Canada Pension Plan payment starts coming in. Your old age security payments begin at 65. And because your retirement income is modest, you qualify for the Guaranteed Income Supplement, a monthly top-up that helps lower-income seniors cover the widening gap between their pension and the actual cost of living in Canada in 2025. Together, these payments form the financial floor your retirement is built on. You feel, finally, like you have made it through. And then you make a decision about your home. Maybe you rent out the basement suite to help cover rising property taxes. Maybe you sell the property and move somewhere smaller. Maybe you spend an extended winter in warmer weather and a relative looks after the house while you are gone. Maybe you simply fill out a government renewal form incorrectly because the language is confusing and nobody walked you through it. The letter from Service Canada arrives. Your Guaranteed Income Supplement has been reduced or suspended entirely, or Service Canada has determined you received payments you were not entitled to and you are now required to repay the overpaid amount. The number on the letter is $14,000 or $27,000 or higher. You are 69 years old, living on a fixed income, and a government agency is telling you that you owe them money you spent months ago on groceries and heating bills and medication. This is not a hypothetical scenario constructed to frighten you. It is a documented, recurring financial reality for thousands of Canadian seniors every year. And the trigger is almost never what they expected. The home you own is not itself what reduces your pension. The decisions you make about that home, how you use it, what income it generates, how certain transactions are reported, and how specific life choices interact with the income testing rules governing Canadian seniors' benefits, can absolutely reduce, suspend, or trigger repayment demands on benefits you spent a lifetime earning. Before anything else, it is essential to be precise and honest about what Service Canada administers, because the claim embedded in this topic's title needs to be examined carefully rather than simply amplified. Owning a home does not by itself cancel your Canada Pension Plan retirement benefit. The Canada Pension Plan is a contributory program. Your entitlement is calculated based entirely on your contribution history and the age at which you begin collecting. Service Canada cannot reduce or cancel your Canada Pension Plan because of what you own. That claim, circulating in various forms across social media and financial anxiety communities, is misinformation. What is true, thoroughly documented, and consequential enough to have destabilized the retirement security of thousands of Canadians who did not understand it in time, is more specific and more dangerous. The decisions homeowners make about their properties interact with the income testing rules of certain seniors' benefit programs in ways that are complex, poorly communicated, and financially devastating when they arrive without warning. There are 3 distinct programs in Canada's seniors' benefit architecture, and they operate under fundamentally different rules that most Canadians conflate into a single vague concept of my pension. The Canada Pension Plan, CPP, retirement pension, is contribution-based and income-blind. What you earned during your working years determines what you receive. Investment income, rental income, the sale of your home, a move to another country, none of these affect your CPP entitlement. It is the most secure of the three programs and the one least vulnerable to the interactions this investigation covers. Old age security is residency-based. You qualify at age 60 if you have lived in Canada for at least 10 years after the age of 18. The basic old age security benefit is not income tested at the point of qualification, but it is subject to a recovery tax for higher income recipients. If your net annual income exceeds a threshold set by the Canada Revenue Agency, $90,997 for the 2023 tax year, your old age security is reduced at a rate of 15 cents for every dollar of net income above that threshold. At a net income of approximately $148,065, the entire old age security entitlement is clawed back to zero. Most Canadians collecting old age security are well below this threshold, but a significant home sale in the wrong tax year, combined with CPP, old age security, and other income sources, can push a senior's net income above it, with consequences they did not see coming. The Guaranteed Income Supplement is where the most serious, least understood, and most frequently devastating interactions with home ownership decisions occur. The GIS is a monthly non-taxable benefit available to low-income old age security recipients. It is income tested and recalculated every single year based on the prior year's reported income. For a single senior in 2024, the Guaranteed Income Supplement begins phasing out once annual income exceeds approximately $21,624, and it is eliminated entirely before income reaches $40,000, depending on the income category. The GIS is the benefit most vulnerable to being reduced or eliminated by housing-related financial events that the senior did not understand would be treated as income events by Service Canada. Here is the scenario that generates the most distress calls to Service Canada offices across the country and the most urgent appointments with accountants who have to deliver news their clients were completely unprepared for. A senior sells their home. They have lived in it for 28 years. The sale proceeds are substantial, $620,000 after discharging the remaining mortgage balance. They deposit the funds. They move into a smaller property or a rental unit. Their accountant confirms that the principal residence exemption fully shelters the capital gain from income tax. No tax is owing. The Canada Revenue Agency, CRA, receives nothing. The senior assumes the transaction is closed and behind them. What they did not account for is the relationship between that transaction and their GIS recalculation. In the straightforward scenario, where the principal residence exemption fully applies and the capital gain is completely sheltered, the home sale should not affect the GIS calculation. The gain appears on the tax return but is offset to zero by the exemption and does not contribute to net income. But the situation changes immediately and significantly when any portion of the capital gain becomes taxable. If the senior had rented out a basement suite for several years before selling, as many lower-income homeowners do to supplement their retirement income, a portion of the property may no longer qualify for the full principal residence exemption. The taxable portion of the gain is included in net income for the year of sale. If that taxable gain is large enough, combined with Canada Pension Plan payments and old age security payments received during the same calendar year, the senior's net income for that year can breach the Guaranteed Income Supplement eligibility threshold by a significant margin. The result is that their Guaranteed Income Supplement entitlement for the following benefit year is dramatically reduced or eliminated entirely, not because they became wealthy, but because a one-time income event in a single tax year temporarily pushed their reported income above the threshold that Service Canada uses to assess ongoing monthly eligibility. Consider an example: a senior who sells a property with a taxable capital gain component of $70,000 in 2024 added to $18,000 in combined Canada pension plan and old age security income reports a net income of $88,000 for that year. Their guaranteed income supplement for the 2025 benefit year is calculated against that $88,000 figure and is reduced to zero. They lose 12 months of guaranteed income supplement payments, potentially $8,000 to $11,000 in tax-free benefit income because of a one-time transaction in a single year. Critically, the guaranteed income supplement does not automatically restore to its previous level when the senior's income returns to its normal modest baseline the following year. Restoration requires active engagement with Service Canada, including filing the next year's tax return promptly so the recalculation can occur, or using the optional reporting of estimated current year income, a mechanism that Service Canada offers but does not proactively inform most recipients about when they need it. The interaction between rental income and guaranteed income supplement entitlement is one of the most financially damaging situations facing lower-income Canadian seniors who own homes, and one of the least discussed topics in mainstream financial advice directed at retirees. Consider a scenario that is common, reasonable, and entirely understandable. A widowed senior owns a paid-off home in Hamilton. Their combined Canada pension plan and old age security income is $17,800 per year. They qualify for close to the full guaranteed income supplement, which adds approximately $10,500 annually in tax-free benefit income. Their total retirement income is approximately $28,300 per year. It is tight, but it is manageable in a mortgage-free home. Rising property taxes and utility costs are putting pressure on the budget. A neighbor suggests renting out the spare bedroom. The senior finds a quiet, reliable tenant and charges $850 per month, $10,200 per year in gross rental income. After deducting a proportionate share of allowable property expenses, including property tax, insurance, utilities, and maintenance, the NET rental income reported on the tax return is approximately $7,000. That $7,000 in net rental income is added to their income for GIS calculation purposes. Their total assessed income rises to approximately $24,800. GIS begins phasing out above $21,624 for a single senior. The reduction formula applies 50 cents of GIS reduction for every dollar of income above the threshold. Their GIS benefit is reduced by approximately $1,588 annually. The senior took in $10,200 in gross rent. They paid tax on $7,000 in net rental income, and they lost $1,588 in GIS benefit income, a clawback that, combined with the income tax on the rental profit, means the effective return on their rental arrangement is considerably lower than the headline rent figure suggested. In situations where the senior's income sits higher in the GIS phase-out range, the combined marginal impact of income tax plus GIS reduction on each dollar of rental income can exceed 70 cents. This is not a flaw or an injustice in the GIS design. It is an income-tested benefit functioning exactly as designed. The problem is that the interaction is almost never explained to seniors at the point when they are making the decision to rent out a room. They see $850 a month coming in. They do not see the benefit reduction calculation happening quietly on the other side of the ledger until the annual GIS reassessment letter arrives and the monthly payment has already changed. There is one scenario in which a Canadian senior's benefit can be genuinely and swiftly suspended. It involves a decision that growing numbers of retired Canadian homeowners are making, often with their Canadian property still occupied or rented. Old age security, called OAS, continues if you leave Canada permanently, provided Canada has a Social Security agreement with your destination country and your years of Canadian residency meet the applicable threshold. The international agreement framework protects your old age security in most common retirement destinations, including the United States, Portugal, Mexico, Costa Rica, and many European countries. The Guaranteed Income Supplement operates under an entirely different and far stricter residency rule. The GIS is designed exclusively for low-income seniors who are physically resident in Canada. If you leave Canada for more than 6 months in any calendar year, your GIS is suspended for the period of absence beyond the 6-month threshold. If you leave Canada permanently, your GIS eligibility ends entirely and does not transfer under any international agreement. For a senior who owns a Canadian home and rents it out while spending extended time in a warmer country, a strategy that appears financially efficient and personally appealing, the consequences can be severe and compounding. Rental income from the Canadian property is added to their income and reduces their GIS through the phase-out formula while they are in Canada. And if they spend more than 6 months outside Canada during the same year, the GIS is suspended for the period beyond that threshold, regardless of their income level. The combination of rental income clawbacks and residency-based suspension can eliminate a benefit worth $8,000 to $11,000 per year for a single senior. A loss that is not immediately visible in the planning stage because the two mechanisms are administered under different parts of the Old Age Security Act and are rarely explained together in plain language. Service Canada has only a limited obligation to proactively inform seniors of these rules before they take effect. The onus sits on the benefit recipient to understand the conditions of their entitlement and to report changes in their circumstances promptly and accurately. This is the gap where thousands of Canadian seniors fall every year, not through dishonesty or negligence, but through a genuine absence of accessible, plain language information at the moments when consequential decisions are being made. When Service Canada determines that a senior received Guaranteed Income Supplement payments they were not entitled to, they issue a formal Notice of Debt. This can happen when the senior's income exceeded the threshold on a filed tax return, when the senior was outside Canada longer than the permitted period, or when the senior did not file a tax return and Service Canada could not assess eligibility. The notice demands repayment of the overpaid benefit amount plus interest calculated from the date the overpayment occurred. Service Canada has explicit legal authority under the Old Age Security Act to recover overpayments through several mechanisms, including reducing future monthly benefit payments, intercepting federal income tax refunds, and in cases of persistent failure to repay, referring the debt to the Canada Revenue Agency for formal collection action. For a senior living on a fixed income of $28,000 or $30,000 per year, a demand to repay $18,000 or $25,000 in overpaid Guaranteed Income Supplement is not an administrative inconvenience. It is a financial emergency that often arrives without adequate warning and without a straightforward resolution. Service Canada will negotiate repayment arrangements in most cases and will not demand immediate full repayment from a senior with genuinely limited means. But the debt accrues interest. The reduction of ongoing monthly benefit payments to service the outstanding debt can bring the senior's effective monthly income below what is required to cover basic living costs. And the stress of navigating a formal government debt recovery process without professional assistance is itself a significant burden on people who are already financially vulnerable. The overpayments that generate these letters are, in the overwhelming majority of cases, entirely avoidable. They occur because a senior did not report rental income, did not file a tax return, did not notify Service Canada of an extended absence from Canada, did not understand that a home sale produced a taxable income component, or did not know that a large registered retirement income fund withdrawal in a single tax year would push their income above the Guaranteed Income Supplement threshold for the following benefit year. These are failures of information delivery, not failures of character or intent. The rules that produced the debt existed and were published. They were simply never placed in front of the senior at the moment the relevant decision was being made. If you found this interesting, check out this video.